In recent years, environmental, social, and governance (ESG) factors have become pivotal in shaping business practices and decision-making processes, particularly in the field of finance. For multinationals, these factors extend beyond just environmental concerns. They touch on governance structures, social impact, and sustainability in operations. As the corporate landscape increasingly prioritizes ESG, its role in transfer pricing, especially in financial transactions, is becoming more pronounced. This video explores how ESG principles are impacting financial transactions within the framework of transfer pricing, and considers whether updated guidelines are necessary to address this shift. The global drive towards sustainability, underscored by initiatives such as the EU Green Deal, emphasizes the importance of sustainable finance. By integrating ESG into financial reporting, organizations align themselves with regulations like the Corporate Sustainability Reporting Directive. This directive mandates that larger companies report on ESG activities, aiming to reduce inconsistencies in reporting and address risks of greenwashing when companies portray their activities as more sustainable than they are. Given the substantial impact that ESG can have on a company's risk profile, it's unsurprising that financial institutions now consider ESG factors when assessing creditworthiness and setting lending terms. A lower ESG risk score can result in reduced borrowing costs, making sustainable practices financially beneficial. This shift is especially relevant for transfer pricing in multinationals, where intercompany lending requires accurate and transparent pricing. Transfer pricing governs the pricing of intercompany transactions within multinational enterprises, MNE. Traditionally, pricing was influenced by factors such as cost structures, market conditions, and credit risks. However, ESG introduces new dimensions. As companies pursue sustainability goals, they may adopt unique business practices that impact their financial transactions. When an MNE ESG performance affects its risk profile, it inevitably influences the transfer prices associated with its intercompany loans and transactions. For example, a multinational with a strong ESG record may face lower borrowing costs in the external market. This could create a situation where intercompany loans should also reflect these reduced costs to maintain the arm's-length standard. The principle that transactions between related entities should mirror those between unrelated parties. This adaptation requires a careful analysis of the impact of ESG on the company's risk profile and financial standing. Companies are increasingly structuring loans to promote sustainable activities within their organizations. An internal ESG loan is one where funds are explicitly allocated for ESG-compliant projects, or entities with high ESG scores receive more favorable loan terms. These internal loans mirror external sustainable financing products, such as green bonds and sustainability-linked loans, aligning internal practices with external market conditions. When assigning a price to these loans, the interest rate, or greenium, as it's often called, may be lower than traditional loans to reflect reduced risk associated with sustainability-driven projects. However, setting such rates in a way that meets transfer pricing guidelines can be challenging due to a lack of comprehensive guidance on how ESG impacts should influence pricing structures. ESG scores offer a standardized approach to evaluating a company's ESG risk exposure. They serve as benchmarks for financial institutions and rating agencies, helping investors and creditors assess the risk and potential of various companies. A high ESG score often translates to a more favorable view of a company's risk profile, leading to better loan terms. In an intercompany context, if the parent company provides loans to subsidiaries with favorable ESG scores, the interest rates may need to be adjusted to reflect the reduced risk associated with those scores. This adjustment ensures that the loan terms align with the arm's length principle, accounting for ESG as a tangible factor in financial analysis. The CSRD establishes a common framework for ESG reporting across Europe, obligating large companies to report on material ESG risks and impacts. This reporting offers a reference for tax authorities and organizations to evaluate ESG-driven financial transactions consistently. While the OECD transfer pricing guidelines currently lack explicit provisions for ESG considerations, the CSRD provides a foundational structure that may eventually influence these guidelines. The arm's length principle is central to transfer pricing, requiring that intercompany transactions between related entities mirror those that would occur between independent parties. In traditional financial transactions, establishing an arm's length rate for intercompany loans often involves looking at comparable third-party loans. However, the absence of clear guidelines on incorporating ESG into transfer pricing makes it challenging to determine comparable transactions for ESG-specific financing. For instance, a subsidiary undertaking a green project may warrant a lower interest rate on a loan from the parent company. Yet, since current OECD guidelines do not address ESG, the onus falls on the MNE to justify the rate as arm's length. A potential solution may involve incorporating ESG adjustments into the risk assessment frameworks already prescribed by the OECD, such as the 5 C's of credit model: capacity, capital, collateral, condition, and character. Introducing ESG as a variable in these categories would provide a structured approach to evaluating the risk and return implications of ESG factors. As both regulatory and market expectations evolve, the adoption of ESG-driven transfer pricing practices will become increasingly relevant. Until formal guidelines emerge, companies should document their ESG-based decisions and be prepared to justify them under the arm's length standard. In doing so, MNEs can lead by example, paving the way for a new era of sustainable, equitable finance.